We welcome all of you, and we look forward to a very hearty discussion, a very practical discussion on the state of global capital markets and the future of finance. Welcome to all of you, by the way. Sitting next to me, I'll introduce each of our panelists. And as I mention your name, if you can tell me a little bit about yourself and why are you up here talking about this topic, right? Because you could go into a lot of different things that all of you have been through in your esteemed careers. David Chua, Chief Investment Officer at Income Insurance Limited. Good to see you, David.
All right. Good morning, Richard. Thank you for having me here. Now Richard is asking me the reason for my existence here on this stage.
Besides looking great.
Yeah. I'm the Chief Investment Officer for Income Insurance for the overseas guests. We are one of the largest composite insurer here in Singapore. We invest broadly globally, right? More than half of our assets are invested outside of Singapore and including the private markets. I have had a career, I was just sharing, my first half of the career was more on the capital market sides with banking. Back then, insurance was probably not the most exciting place to be in. But I think the last 3 to 5 years, it's gotten a lot more exciting, particularly with the rise of private markets. It's an important part of our allocation, and I'm happy to have this chat with my fellow panelists here.
Fantastic. Yeah, a lot of esteemed folks here. Noriko Honda Chen, Management Committee Member, Portfolio Manager at Capital Group. Good to see you, Noriko.
Thank you, Richard.
Tell us a little about yourself.
Yes, so I lived in Asia for 23 years in Tokyo and also in Hong Kong. And I started off as an analyst covering energy and infrastructure across the region. So I've seen quite a lot of change over the past 20 to 30 years.
A little bit, right?
I hope to be able to talk about some of the positive changes we're seeing today. From a management committee perspective, we're also very constructive on the region. So, spending a lot of time thinking strategically about how we plan to grow in the region. Fantastic.
Welcome. Michael Gousset, CIO, Global Head of Fixed Income, Principal Asset Management. Mike, good to see you.
Thank you, Richard. Good to see you all, and thanks for everyone joining us today. I think this is a timely event for us as we see the capital markets are changing. The influx of private markets has certainly changed the way that we think about investing in markets. It certainly has created a different suite of opportunities for investors, both from allocator as well as an active manager. So we at Principal, where I serve as the head of fixed income, we manage money globally. We think about opportunities across all these different elements of both global markets as well as within the markets. How do you extract value into these nuanced ways that you as clients very often expect us to achieve?
Fantastic. Welcome. Hisham Hamdan, CIO of Khazanah, the Malaysian Sovereign Wealth Fund. Good to see you.
Good to see you. Thank you, Richard, and good morning, everyone. My name is Hisham Hamdan, CIO of Khazanah, so Sovereign Wealth Fund of Malaysia. I've been on the other side, sell side, analyst, banker, now with Khazanah. So most of us, a lot of our assets are here in Asia. So very, very important that we understand what's happening in Asia, and it's not been great. So I'm also a supplier as a capital, also user as a capital, being a chairman of some other companies. We have to fix some of these companies. Same time, we have to get return. So those are things that we can discuss today.
Great. Hisham, one of the points you bring up often is that Asia contributes 50% of the global GDP, right? Yeah. Just Asia itself, yet 2/3 of global growth. When you're looking at it, why hasn't growth translated into returns from your perspective?
Interesting. So it's really emerging market and developed market. 50-50 growth is going to be emerging market, but this year has been great. This year, if you are emerging markets, up about 25%. Developed market 15. So it's been equities about 16, 17. So we've been very, very happy this year. But if you look at the last 10 years, it's not been easy. It's not been easy. Emerging market 5%. I think developed market more than 10% or 12% or whatever it is. So something is not translating to return. And partly, if you look at public market, I mean, say equity, despite 50%, only 10% is emerging market. I mean, China, for example, 16% of GDP. But probably 3+% of equity. ASEAN about 1%. The SMC alone equivalent to ASEAN at 1% in terms of. So a number of things, whether free float, whether MSCI allocation, whether productivity of our companies, whether a lot of it owned by SOEs or some of the entrepreneurs and tycoon, those are things that we need to think about it. In the long run, it will have an impact on Asia. And I think emerging market, or Asia especially, is undervalued. And the last 10 years not been great for us. So something that, if you're in Asia, where the bulk of your asset is here, like Khazanah, or my Dilhan in Temasek, or Pandu in Danantara, something that we have to really improve the entire ecosystem rather than go alpha hunting. So those are things that we care about, and something that we all need to think about it.
Noriko, so 50 trillion out of Asia, right, in terms of GDP. Undervalued is what Hisham was saying. What's your perspective?
So we have capital as of this morning, about 213 billion in emerging markets, and 240 billion in Asia, both North Asia and South Asia, and invested both in equities and also fixed income. I agree. I mean, if we saw more opportunities, investment opportunities, we would have a larger share out in Asia. And the reason why, and when I was an analyst 27 years ago, we actually owned a lot more ASEAN back then. But what's happened is there's been a lot more regulation, some restrictions around capital controls, restrictions around ownership limits, and foreign exchange controls, and that has just led the markets to be less attractive to us. There's also a large component of the markets are dominated by state-owned enterprises that are not maximizing, I think their main goal had been for full employment for obvious reasons. But I think now as demographics are shifting, you're starting to see governments start to focus a little bit more on let's get these companies to be more profitable. And I think that is a good change that we would welcome.
You said more restrictive. Do you see that changing in the next 10 years?
We hope it's going to change in the next
10 weeks. Okay, all right, well.
We're already starting to see the changes. When we look at Japan and Korea and China, the governments there are already starting to, in fact, focus a lot more on corporate governance reforms. So Korea just this year has improved reforms for minority shareholders. We expect to see more targets, kind of soft targets being set by these governments. And again, that creates a much better flywheel for investors as we look for companies that are going to be more profitable and generate, stronger shareholder returns. I have a colleague now that's he's on the Danantara board, and a former colleague. And, they're also very focused on basically increasing liquidity. If you don't have kind of minimum liquidity in the market, we can't even get into the market. We can't invest in the companies. So we need more liquidity. We need a lot less regulation, and we need profitable companies, right? But if we have that, I think it's a great opportunity to invest.
Mike, North American perspective from where you're sitting?
Yeah, I mean, I think what it comes down to very often is that investors chase returns. So as we said earlier, the prior decade was one where Asian returns didn't stack up with many opportunities in the rest of the world, and then capital flows that way. Energy from a research perspective, energy from an opportunity-seeking perspective starts to focus more on where are there opportunities for us to generate excess returns. And so I think that's limited some of the capital into region, and also I think probably most importantly as an active manager, it's limited the liquidity of the market. So you start to think differently about can I get in, can I get out? Probably more importantly as being a caveat before you would ever consider investments.
David, from your seat looking at insurance, and you've worn a couple hats as you described earlier in the last 2 decades or so, reflect on this 50% that we've been talking about.
Yeah, well, I think in our position as an asset allocator, oftentimes I think we think about where is the best return risk trade-off. And for us as an insurance company, typically we are liability driven. We have our liabilities in Sing dollars. Naturally, the preference would be to look into Sing dollar assets. But the reality is the savings ratio in Asia has boomed so phenomenally that there is therefore a need to chase and look for returns beyond outside of Asia. And I think that's been a trend that you see in many other insurance companies around Asia. With that, I think coupled with US exceptionalism the last 5 years, I think you have seen maybe today, if we were to take a poll around the room, right, whether you're at 60, 70, or 80% towards the US, it just feels like maybe it's a couple of percentage a bit too much. I think where we are today, just reflecting on the Noriko's point of view about Asia, I think Asia equities Asia space has been very interesting, right? Back in the 90s, you see a wave that was driven by Japan, right? And back then, probably at least 40% of your Asia exposure would be in Japan. The second wave was in China in the early part of this century, and this was where China had a great run-up. Back then, GDP was 7 to 8%. For some of the investors, it may or may not have translated into actual returns at that point in time. So I think where we are today, the cost of hedging, of offshore investments back into Sing dollars is challenging. It's starting to get a little bit painful. We are also reviewing how we then allocate assets between Asia, US, and the rest of the world.
Since you're a surfer, you've described two waves. What's the third wave you're seeing coming down? Where's the swell? Tell me where the swell is.
Yes, I think today, if you look at where the growth is within Asia, a lot of people are talking about India, right? There are obviously structural reasons behind it. Japan has a little bit of a revival. And I would say the third area that one should not neglect would be also ASEAN. ASEAN as a population of the world today has a material clout. And this is where I think, depending on where you see the growth channel to be. I would just want to add maybe one last point around earlier there were conversations around demographic. If you look into 75 years ahead, 2100, and all of us like to think we are long-term investors until we're not, right? 9 out of 10 of the population will be residing in Asia as well as in Africa, right? And if you are therefore thinking about a long-term horizon, it starts to make you question around how your portfolio is positioned today, and is that the best way to optimize in the next 75 years?
Noriko, both your hats on here on the management committee as well as portfolio manager. When you think about the efficient frontier here in Asia, one of the questions that's posited, is it broken? What are the opportunities in weak beta in the region? How do you discuss that?
Yeah, well, I think that the beta has been weak because, again, you haven't had companies who are acting as profit maximizers. So you really can't invest passively in the region if you don't have companies that are actually representing the value of what should be their economic value. So that's why it's been a great time for active investors. But I do think that things are shifting. I think that the word for this year has been diversification, right? So this is the first year since the global financial crisis that you've seen money flow basically outside of the US into international markets. So the international markets have done much better than the US market. EM is up 27%, world is up 25%, Japan's up 20%. While the U.S. is up about 14.5%. And they're going to where the returns are. They're going to where earnings are increasing. And so I think that, again, we should be able to continue to see this kind of diversification as we see a number of these companies continue to improve their returns.
By the way, panelists, please interrupt at any moment. You don't have to wait for me to ask a question. I like that. I'm a cable TV guy, so just be nice to each other. Hisham, to you, the very same question. Is it broken, the efficient frontier, and where are the opportunities in weak beta?
Yeah, we've been saying this. The problem with emerging market and probably Asia is the systematic risk, where normally 80-90% of your return will come from that allocation and exposure to beta or systematic risk, and Nico said. In Asia, in emerging market, it's supposed to be a higher vol, but unfortunately, the return last 10 years has been 5%. Developed market, lower vol, the other way around, right? So for us who invest in multiple asset classes, whether public market, private equity, or VC, investing in the US has been fantastic. We go passive, we tell our managers, take 1% active risk, don't be too smart, because alpha is zero-sum game. I just love to ride the beta. It's been fantastic. When it comes to emerging market, passive is a problem, because it just accentuates the problem in Asia where beta has not been rewarded. So what do, right? We need more and different kind of investors, whether private equity, whether shorter activists, or VC, because they will have to shape the company.
Yeah.
Passive investing, unfortunately, I call it is neglectful parent. Some of us, we own this company, we just like helicopter parent, right? But we need to go down and work with all this, whether shorter activists, they can co-parent and shape some of our company that have been non-performing, or VCs that funding some of the insurgents, so they can fight the incumbent. That's how you renew the beta. And unfortunately, for emerging market and ASEAN, a bit toward China has been great this year, but ASEAN, unfortunately, 40% of the index are banks. And what does it say? Banks making enough money, but the non-bank is not there. So that's something that collectively I welcome all the co-parents out there. We're a public market, please play active, shape our company, and the private equity, please go and buy some of the non-performing asset, and VC, help some of the parents of funding innovation, whatever it is. The question, where does innovation come from? China invests, well, rather China spent $500 billion on R&D per year, which is bigger than some of the GDP company of Malaysia or Singapore or Philippines, right? So if you look at as Asian bloc, in terms of GDP-wise, we're almost 30 trillion, as big as the US. So rather than reinventing things, trying to sort of find your own alphabet, investing R&D, work together. Japan, Korea, Taiwan, plenty of this new technology. In China, have access to some of this new technology. Work with them, and that's how we improve the beta. From funding the small companies, shaping the old companies, and also making sure that they all perform with the ROE, with the growth. These are things that I welcome all the global asset allocators here have to come and co-parent our companies here. That's the thing that we need to do.
All right, since we're talking about dating now, what do you look for in a good co-parent? What's the magic?
Well, you can be neglectful parent, don't do anything, let the kids run, that's passive investing, right? They just, as I said, it's just whatever the company's there, whether they're good or not, because they're part of the index, you invest. A private equity, unfortunately, is not big enough in Asia. It could be a function of return, or could be a function of ability of this asset, because SOEs probably do not want to let go. Some of the entrepreneur tycoon probably have emotional attachment of their companies, so very difficult for them to source. And some of the active investing or shareholder activists, for example, they're beginning to take shape in Japan for the last 10 years, or Korea. They can challenge the companies, but because the dominant control is coming SOE and tycoon, they can't do very much here. So we need parents that challenge. We need a parent that, hey, you're not performing. Why don't you demerge the company? Why don't you sell the asset? Hold the board and chairman accountable. That's why we get a company to do well. So we need all kind of parents. Right?
Richard, I'm sorry.
Yeah, go ahead.
Just from a public markets perspective, I've been doing this a long time, as the gray hair shows. And 30 years ago, all the rage was, how do we globalize portfolios? From a U.S. perspective, I was sent to London to the advent of the euro and to start to think about the changing dynamics of markets and how it was becoming smaller and how investors were really focused on maximizing returns, irregardless of how or where those returns were coming from. The U.S. market dominated the return cycle, though, for the last 20 plus years, and I think investors, as David said, started to shift their focus, shift their capital to where they perceive to be the best opportunities. That's what's still missing in a lot of these global markets, is that I'm looking at it, we manage global bond portfolios, we start to think about how do we allocate capital, and there are opportunities, but I worry about things like liquidity, as I've raised a couple times. I worry about, how much confidence do you have in some of the underlying fundamentals and the quality of these issuers? And am I doing diversification for the sake of diversification that doesn't necessarily lead to returns? So I think, as this region continues to mature and grow, and some of the things that the panelists have talked about, that's going to encourage investors outside of region to also focus on this as a great place to invest.
If I can add on to the conversation, I think the passive, obviously, as what Michael said, has driven capital to a certain direction.
Right.
I think the opportunity with the rise of the private markets, the demand coming in from retail, adding a further push behind it, is actually an opportunity for Asian companies in order to tap on the market. For sure, there is demand. It's just a case of whether can supply keep up with what's the growing demand out there.
But I think we need a lot of top-down government and regulatory change as well. David had mentioned Japan. I remember when Japan was 40% of MSCI World, and now it's 60% today. It's just been a huge kind of destruction in value. And a lot of it was because they just didn't allow companies to go bust and, kind of a proper capital, framework to kind of revive. And I think it's just this year that one of the Japanese banks finally paid off one of the loans to the government. So it's taken 20 plus years for the system to get back into a healthier state. Now, going forward, again, there are a lot of opportunities because I think the companies are much more focused on better businesses, possibly even selling down or writing off loss-making businesses. We have to allow them to do that. So then you can invest in new innovation and in new companies. And then the governments also have to make it basically facilitate an ecosystem so you can have innovation and you can have entrepreneurship. You need to get the risk capital, you need to get the ideas, you have to have funding, you have to fund research. I think that there's actually an opportunity right now, because it's harder to do some of this in the US, to bring back some of your smartest people to Asia to kind of restart some of this. And so, again, huge opportunity at the moment.
Looking at capital markets, 30 seconds then, Noriko, what's the teaching lesson that you just brought up coming out of Japan specifically for other economies in Asia and ASEAN?
Well, I think we've all seen it, but it's basically, when you allow your companies to kind of just stay publicly listed, but just kind of limping along for 20 years, like it's just not healthy for, the companies or the markets. I mean, you do have, full employment, and maybe that's good for that particular point in time, but then the companies become less globally competitive. Like if you think back 20 to 30 years, the companies that were top, right. Tech companies in Japan are no longer those top tech companies, right? So, they need to continue to invest in the business, provide returns. It's not just, just trying to be bigger for the sake of being bigger.
Thank you. David, short-term risks. What's the number one you're watching right now? How do you turn it into a win?
I would say definitely liquidity. Right? In today's environment, there's a lot of money that's still on the sidelines. If we talk about the money markets, the last I checked, it's crossed $10 trillion. That's a lot of money that's sitting on the sidelines. But as we all know, when there's a fire, we all head for the exit, right? So I think for us, especially when we think about how do we meet our liability cash flows, I think that becomes even more important, especially with the advent of private markets that's coming into play. Now, I think on the private markets, there are, certain positive developments in terms of semi-liquid, the growth of secondaries in the market. I think these are all very healthy growth, right? But I think, again, right, every investor is different. Be very mindful about your cash flows and your liquidity, especially at a time when you least expect and you do need it.
What's the lever you're watching for loosening of liquidity?
I wouldn't be smart enough to tell us how to
come on.
the website.
It's just between you and me.
Yeah. No, I still go back to, we are in the midst of entering in the new regime after the QE, right? It's called QT. I think we've heard the term for years, right? It's going to take time for it to reverse. But as we all know, it is reversing, right? So the question is, always put your finger on the button, right? Just be ready when the time comes.
Mike, to you on this question, what is the short-term risk number one that you're watching right now? I know there's more than one. And what are you thinking about how to turn that into win, in the next cycle, whatever that cycle might be?
Well, there's the elephant in the room, which is the deglobalization, the efforts of the U.S. around tariffs and kind of pulling back as a global partner for the world. And I think that's probably the biggest short-term risk. And it's a big unknown. We don't know the answer. And I'm not here to make a political discussion out of anything, but I think that's something we all need to be mindful of and to be thinking about and to take into account when we're going through our investment thesis on different ideas. How do you turn that into a win? Well, you start to think about what are the implications of a deglobalization, of retrenchment back into the U.S. What does that do to inflation? How does that impact growth? What does that do to labor supply? And to us, what that really is translated into is that you're going to see money chasing more things locally. The local investments in fixed income are becoming more important. From us as an investor, it also means that you start to think about the inflation sensitivity, which will likely play out in terms of U.S. inflation or even global inflation for that matter. The decades of really no inflation is something that's behind us. And how do companies operate in that scenario?
Right.
How do governments operate in that scenario? As investors, you start to think about what does that mean for yield curve? What does that mean for Federal Reserve policy? How does that play out in terms of quality as many global governments in the developed market side continue to run massive deficits? And so, those are some of the things that we're trying to position for and to think about on a forward-looking basis. But, the way that the last, kind of 6 months have gone, this could turn pretty quickly as well. So being nimble, liquidity, I'll bring it up for the third time. Liquidity is something that we're very focused on and concerned about. And it also is forced us to think differently about some of the local investments here and how we're going to be positioning our portfolios.
We'll call you the liquidity guys. What we'll do. If deglobalization is 10 chapters, whatever that full story is, because it takes time, right?
Sure.
What chapter are we in? 1, 2, 3, 4, and I'm going to ask all actually our panelists. What chapter are we in of 1 to 10?
Yeah, so it's early. It's inning one. It's
chapter one.
Chapter one.
Okay.
I'm a baseball guy, so I'll go with the innings.
Chapters, innings, but there's only 9.
And could be anything between 2 to 5.
2 to 5 right now is where we're at. What do you think, Noriko?
I think it's early, but I think it's also not deglobalization. I think it's a reglobalization. I think you're just seeing a shift in trading partners. So when you actually look at trade data, the absolute dollar amount has not declined, right? It's just countries are trading with different partners, and they're finding new partners. And so we're seeing, and when you look at just geographies, U.S. companies, 40% of their earnings are from outside the U.S. Like, is that going to change significantly? Probably not. And same for Europe and Asia. A lot of earnings are coming from different regions.
So what chapter?
So I think it's still early in the shift.
Got it.
Yeah.
And I think that there are a lot of
reglobalization. And I think there are a lot of opportunities for that from countries and companies that are going to benefit from that trade shift.
Well, I think
What
the
chapter?
perspective that I will answer that. I think the perspective that we are moving towards a bipolar/multipolar world, right? Today, the dollar is still the reserve currency of the world. It's going to take a long time. There's no other alternatives that's out there that's viable, liquid, and of the size. I would say we're probably at the introductory chapter.
All right. Or just introduction so far. We haven't even started chapter 1 is what you're saying. You brought up India earlier. Hisham, I think you did, right? We look forward 5 to 10 years. We look at India's growth to the point Noriko was bringing up about re-globalization. We're looking about the shift of manufacturing, right, from China to other geographies and markets. What does this do to the Asia trajectory as we look at this, India now and its future?
Look at India. The GDP roughly almost $4 trillion now. GDP per capita anywhere between 2005 to 2000. ASEAN also about $4 trillion. We've been very, very happy with India. We have always over with India. We believe that strong macro growth. So India, one of those things that just right the macro growth, and I think eventually they will get to whatever $6-7 trillion. There's plenty of opportunity in terms of return, whether public or private, whatever it is. But I just want to go back to talk about the risk just now, Richard. The risk for me is, as I said, I don't really pay attention to alpha, the zero-sum game. One manager make money, the other manager behind, so I care about the rise of the entire market, right? So I started this industry in the roaring 90s. What happened in the roaring 90s? 2 major things. One is because of geopolitics, a trade issue, Japan had to bring all the industry here, and US interest rate had to brought down to 3% or whatever it is. So therefore, there's plenty of money from the US in order to arbitrage interest rate, and also Japan coming here. So what the risk here? The risk here is Asia or emerging market will do well when US bring down the interest rate. So potentially at some point, 200-300 basis point, and China coming relocate this part of the world. My worry is we not being able to take advantage of that. 30, 40 years ago, ASEAN industrialized because of that trend, mega trend. This time around, China 2.0 in terms of coming out can be good, also can disrupt some of our companies here. Those are risks to me that I worry about some of us sort of old companies in this part of the world. So back to India, they done well. I think we'll continue to enjoy what India is doing. Once in a while, this year, not so great. But they've done fantastic for us the last 10, 15 years. We just love India. And to the point where I hardly visit them, I say, you're doing well. You don't need my attention. I spend a lot of time in other countries because I say, look, just stay with the market, whatever it is, just enjoy the beta. Yes, once in a while you underperform, that's Noriko problems. to me, I love the.
She's going to get in on this.
Yeah.
Yeah.
So, you know.
So our pessimist
Yeah.
in the corner there.
Yeah. Well, I agree. I think the opportunities in India are very significant, and it's probably going to be one of the biggest growth markets globally over the next 2 decades, right? So, per capita GDP is about $2,500 on a PPP adjusted basis is about $12,000. But you're back to where China was about 20 years ago. Can the GDP double? Most likely. Right? So that's why India is super attractive. Now, India was a little expensive from a valuation perspective about a year ago, 2 years ago. And so the companies kind of have to grow into some of those valuation, and you're getting some competition. But we think the market longer term is very attractive. And you're seeing more IPOs. You're seeing a lot of kind of the market broaden in the country, and for investors, that's very attractive. There are some potential risks. I think AI could be a potential risk for India. The IT industry is a very big industry, very important to India, and it could be slightly disruptive initially, although hopefully they can leverage it a little bit more in the future. And I think the Indian government has to be a little faster in terms of the pivot from China. So China +1 manufacturing policy. India would be an obvious place for companies to go to manufacture, and the Indians just really have not leveraged that. I think Malaysia has probably done a better job at doing that, and maybe Thailand.
Yeah, and I would also add, other than equities, the growth of the credit markets, which I'm sure Michael can elaborate more on, has been very healthy. I think for most Asia credit investors going into 2022, many of us were obviously invested into the high yield Chinese real estate space, which was highly concentrated. And I think the growth of other markets such as India, both on the investment grade and the high yield space for capital raising, will always be a positive for the region.
Yeah, I mean, I would chime in on I was going to go to the credit markets, to income, to thinking a little differently from a practical perspective as an investor. You certainly have seen the development of many of these and the maturing of many of these populations. Wealth creation, as was pointed out a couple times now, has had this growth in the middle class where there is more local demand for retirement-oriented products, for thinking about how do you generate income longer term. But the credit markets are still, and I'm not going to go to liquidity again, but it's very different. And I think for large institutional investors who need to put large amounts of capital to work, you still need to go to these bigger markets. You still need to focus on the U.S. You still need to focus to some degree on Europe, and where they can truly put capital to work. And so I think global is still a thing, despite what I mentioned about my deglobalization comment earlier. I think from an investment perspective, you still need to be able to open up the capital markets to be able to be focused on where the best place is for the marginal dollar.
Hisham, actually, I'm not going to go to you first. You're going to be the focus of this next question indirectly here. I'll go to David first. How about that? When you're looking at governments in Asia, what are they doing to encourage, if you will, improve markets when they're working with sovereigns and policymakers, and what can be done better, you think?
Yeah, I think in recent years, there's been a lot of actions that's been taken, perhaps going to be accelerated after the events of this year, towards trying to improve on a very fragmented and efficient markets, as what we have discussed, right? And as the topic suggests for this forum, I think there are potential for collaboration, right? It's never a zero-sum game. The challenge is there is a pool of capital that's waiting to be deployed. How do they then, across Asia, as for us, I wouldn't say they, us, then galvanize ourselves in order to bring in the capital? And I think with that, it comes across with a few things, right? One, as we think about how do you unlock local private capital, right? Example of insurance capital, right? That's actually consolidating all the savings, and Asia loves to save, right? With that 30% of savings, how do we then galvanize that in order to support the growth that's coming out of this region by deploying the capital more effectively? And I think the other bit I would add is also on the distribution side, right? How can we then improve the financial literacy of this part of the world, coupled with upskilling the distribution from financial institutions such as banks, as well as an insurance company? And perhaps maybe the last and final point I would say would be, if you talk about growth of stock market, a lot of it has been driven by very shareholder-friendly capital management, right? In the form of dividends, share buybacks, example. And I think more could be used to encourage in that perspective. Because Asia is aging, right? The demand for income is just going to grow, right? It's not just about growth, but it's also about income generation.
Noriko, you brought up this topic a little bit earlier. You intimated it. Reflect on that. And is there a best practice that you're looking out there? Is there a government that you said, that's a good move?
I think the governments are becoming more open, and as a result, we've set up a new government affairs team based out of Singapore to work with a number of governments across the region. And in fact, we just had some team members in India talking to SEBI. But there's much more open to dialogue, and I think India is a good example of just setting up a new program like Gift City, where you're really trying to kind of make sure that at least try to facilitate some more trade for foreign investors. Because right now it's still very difficult. There's still a lot of restrictions.
Mike?
Yeah.
Oh, sorry. Go.
No, go for it.
Yeah.
Oh, yeah, you go.
No. I was going to pass along the mic to the star here on
It's going to Hisham at the end, yeah. Okay, over to you.
Yeah, if you look at the countries that have escaped the middle income trap, right? Where are these countries? Countries that joined the European Union. The Middle East country with the oils, and East Asian countries. What are the role, or how do they escape, right? Whether Taiwan, Korea, Japan, then, or increasingly China. All of them use the instrument of the states. So in the US, Europe, the role of markets, but here we have to appreciate the role of state. So our mandate, for example, not just commercial return, we have to worry about strategic mandate and also social mandates. So this thing that we have to balance all the paradoxes or competing demands of how do we get the country out of middle income track, whatever it is. So even China, for example, right? Plenty of technology, R&D, and the role of the state SO is very, very important. And Korea, for example, they spend 4.5% on R&D. Other countries, China maybe about 3.5%, and Asia, ASEAN maybe 1%, right? So how do we balance this? I mean, we are, even in Kazana, how do we balance this? It's not so easy. And number of things is Japan, for example, really sort of announced that, I remember, 10, 15 years ago, 8% minimum ROE, whatever it is. A bit of Korea and Japan welcoming the shoulder activists. And I think China, to the extent, we're thinking about the capital markets, right? So there's something that Asia and ASEAN need to do in terms of improving capital market. But at the end of the day, if you look at the economy of these countries, still a bit of an old economy, right? So therefore Kazana, for example, our VC in this world has been very, very difficult, but we voluntarily allocate a lot of money to VCs, fund of fund, the Jelawan Capital, in order to ensure that we fund these insurgents, we fund these young companies, we bring the foreign VC in order to work. So those are role of what we do, and as well as for the last 20 years, we've been trying to reform some of our companies, right? But it's not so easy. We have to balance between ensuring the financial return and strategic return, and we own some of the key asset, utilities, telecom, bank, and we have to constantly balance the need of stakeholders, whether job creation, whether performance of the company, whether we do certain things for the country. So I think in ASEAN, you can't run away from the role of the state or the state agencies, right. SOEs, and how do we balance that? That's why I welcome the more capital, I call it, whether active capital or smart capital, and to work with us in this part of the world. And obviously, we got about free float issue on this.
How do we balance that?
Well, sometimes mathematics doesn't add up.
Right.
So the roaring 90s, when a lot of flow coming here, and when eventually collapsed in 1998, we got plenty of infrastructure, cheap money coming in, right? So now, if all this money coming to Asia, just make sure that we take advantage of it, because eventually that will help with the cost of capital. Otherwise, emerging market trading at 15, obviously India trading at 25, 30, 40, and developed markets enjoy this, great PE, which means cost of capital very low. So those are things that we need to think about it. How do we welcome them? How we partner them? At the same time, making sure that we don't disrupt so much, because otherwise the return all to capital owners, then the labor doesn't get returned, then we get into trouble. I mean, we've seen that in other developed markets where capital owner get the bulk of the return, the labor doesn't get returned, you get all the inequality issues. So we have to balance that. That's not so easy.
Getting close to the end of our discussion, and if you could keep your answers to 30 seconds on this, that would be great. And this is the help me get smarter question, Noriko. What's one sector in Asia you think is overhyped and why? And one sector you think that is overlooked and why?
Well, I think that it's, we have been pretty active investors in banks, financials across Asia, even though, they're considered to be kind of older economy. And what we've seen is a significant improvement in bank management teams focusing on, a lot of the banks actually were overcapitalized, so distributing dividends, doing share buybacks, and it's resulted in price to books increasing quite a bit for several banks, not just in Asia, but also in Europe, from I would say like 0.3 to 0.4 times to about 1 times. We see continued attractive opportunities within a lot of these older economy sectors that can be continue to improve in terms of shareholder returns. It's not overhyped. I mean, I think that, everybody talks about AI. I'm a huge believer in AI. I mean, I think that this is the next big tech mega cycle, and everybody, if you're not using AI, you should learn how to use it, and you should make sure everyone in your company knows how to use it too. And the reason why it's so, big is because you have a $100 trillion economy, global economy. 50% of that is labor, right? So right now they're assuming that the AI market will be about 2 to 3 trillion by 2030. So if you think between 3 trillion and 50, it's obviously where a lot of, that's one of the reasons why you're seeing massive investments. Some of those investments are going to be front-loaded, and some of the money that companies invest will not be return-oriented. And usually when you have big changes like this, there are usually only 2 or 3 leaders that end up being leaders over time. So I think, again, active management, the entire industry will continue to grow. There are going to be leaders, but there might be some losers too, so you need to just be aware of that.
Mike, long 30 seconds to you, same question.
Yeah, thank you. I'll take a slightly different tact on this, and I'm a public fixed income person, so to be clear, I'm biased. I do worry about the private markets. I worry about the uncertainty of we haven't really gone through a true cycle. There's been a lot of money chasing them, a lot of people in this room, a lot of people on the stage even, who have been chasing the returns that are promised in these private equity, private credit types of products. It makes me nervous that we haven't seen a cycle yet. We talk about AI and the investment there. I agree. Early first chapter, to use your earlier. But it is still early days there. There will be pets.com that evolve out of AI as well, which are big losers. And I think we've seen massive amount of money flow into this private markets. It's pulled capital away from the public markets as well. I'll give you one good stat to walk away from. The global high yield market used to be 26% triple C issuers. It's still 11%. Those companies didn't go away. They didn't all get upgraded. They are sitting in the private markets because it's easier. It's cheaper to some degree to get access to capital there. And so those are the companies that wind up having problems when the economies turn. So I guess my big risk or my big concern to your specific question is the uncertainty of what that private market is going to behave like in a turn in the global economy, and then what do investors do then?
Overhyped, overlooked.
Overhyped consumer plays, right? I mean, I think the easy way to play in Asia is always let's bet on the consumer trends. But who knows, Labubu was going to be such a craze, right? If only we knew. So
it's on my network a lot for some reason, yeah.
Consumer trends are fickle, right? So that's always going to be a challenge to try to time it. Underrated, if I look at the circular trends of AI, demographics, climate transition, it points me towards infrastructure as a place that's underlooked.
Thank you. Hisham.
Well, I'm not alpha hunting. I'm interested in beta fixing, right? So to me, is emerging markets still underhyped, still trading at below where it needs to be. And to us is we don't have the luxury of not owning some of these assets because we're here, we are home buyers. So as I said, I welcome all these people to improve the productivity of the company so that PE can be lower. And to us is beta fixing or beta activism in nation building. So that's something that to me is emerging market under high, only 10% of ACWI. 50% of GDP, two-thirds the world, GDP growth. So this is where you need to be. Therefore, help to improve our company. MSCI, please allocate a bit more. Instead of 20% of China A, make it to 50%, whatever it is. Then we're going to go to 15 and 20% of ACWI. Yeah.
We will, so the way we start is the way we end, based on your statement. From each of you, one sentence. What is the state of global capital markets in the future of finance? One sentence. Mike, I'll go to you first.
Well, so this is a tough one, and it's tough in one sentence, but I think that we're sitting here looking at a future of uncertainty, and that plays out not only in geopolitical noise, but also in terms of the capital markets. So that creates opportunities. I am an alpha hunter, and so I think that it bodes well for us to be able to create active portfolios to source that alpha.
A lot of colons and commas in that
Yes,
one.
thank you.
David, to you, one sentence.
Yeah, no, I would say that I'm very much positive. I think there are a lot more choices in terms of the different asset classes. There are risks involved, but let's be mindful about what are the underlying risk factors before you jump into things blindly.
One sentence to you, Hisham, the state of global capital markets and the future of finance.
We need a bit more alternative, even though sometimes the return is slightly below the public market now. We need more of them. We need more active investors. So we welcome allocation to public market, but the private credit or BC, especially in Asia, we need more of that.
Noriko, take us home.
Yeah, I think we're in a state of unprecedented transition. And so, transition creates opportunities. And I do think that there are going to be many opportunities in Asia, but you need to be an active investor to find them.
All right. Warm round of applause to our panelists, please. Thank you so much.
Thank you.